Welcome to the Opening Bell Report.
First Majestic Silver was a company that, fundamentally speaking, looked entirely broken.
Oh, completely.
I mean, we were talking about an operation that was basically bleeding cash, struggling with heavily compressed margins, and facing a highly uncertain corporate future.
Right.
But fast forward to today, and that exact same company has pulled off a historic 500% run. We are looking at one of the most structurally impressive corporate turnarounds in recent market history.
It really is a phenomenal case study. It demonstrates exactly how rapidly a company's financial profile can transform when, massive macroeconomic tailwinds align with ruthless, highly strategic corporate execution.
Yeah.
And the mission of our deep dive today is to analyze exactly how First Majestic, ticker symbol AG, engineered this turnaround. We're drawing from a comprehensive analysis report that really breaks down their transition from a struggling, cash-burning entity into an absolute heavyweight in the precious metal sector.
Okay, let's unpack this because we really need to establish the baseline mechanics of this move for you before we get into the weeds.
Good call.
Looking at the 52-week trading range, First Majestic was sitting at a low of $5.09.
Yep, 509.
And from that trough, the stock drove essentially straight up, piercing $32.04.
It's just massive.
From a market capitalization standpoint, they went from being viewed as a huge liability to a $15.7 billion juggernaut. That is the kind of repricing that forces institutional investors to completely recalibrate their models.
It does, but you cannot analyze a repricing event of that magnitude in a vacuum.
Yeah.
I mean, the internal corporate mechanics are vital, obviously, but they operate within a broader commodity environment. And right now, that environment is experiencing some severe supply and demand dislocations.
Absolutely. The silver supercycle is the undeniable engine here.
Yeah, without a doubt.
You look at the data from the analysis report, and spot silver has been aggressively testing the $88 to $90 per ounce range.
Mm-hmm.
We just haven't seen this kind of sustained upward pressure in the silver market in modern history.
Right, because the structural deficits are compounding. You have massive industrial demand from the solar and EV sectors,
Colliding with flatline global mine supply.
Exactly. The supply just isn't there to meet it. And that macro environment highlights why AG is currently commanding such a massive premium. The analysis report frames First Majestic as a prime high beta play on physical silver.
Let's break that down for the listener. High beta.
Right. So to put it simply, when we say high beta in this context, we mean that historically, when silver goes up, say, 10%, AG goes up 20 to 30% due to operational leverage. It magnifies the move.
Because the fixed costs of pulling that ore out of the ground remain relatively static.
Exactly.
So if your all-in sustaining costs, your AISC, are locked in at, let's say, $20 an ounce, the delta between $20 and a $90 spot price is pure margin expansion.
Pure profit.
Every incremental dollar silver gains drop straight to the bottom line, and the company doesn't even have to lift another shovel.
Precisely. The leverage works incredibly in their favor at these price levels. However, as any seasoned mining investor knows, a rising tide does not lift all boats equally.
That's very true.
There are plenty of mid-tier producers who had the exact same $88 silver tailwind and didn't see anything close to a 500% return. The macro environment provided the necessary runway, sure, but AG's management had to completely overhaul their operational philosophy to actually achieve liftoff.
So let's look at that operational overhaul, starting with the glaring flaws in their 2024 strategy, because the numbers from last year were undeniably grim.
Brutal, honestly.
We are talking about a negative net profit margin, and they posted a net loss of $101.9 million.
Yeah.
The fatal flaw was that management was aggressively chasing volume at the direct expense of their profitability. They were trying to hit production guidance by mining lower-grade veins.
It is the classic trap in the extractive industries. Management teams often feel immense pressure from the street to show quarter-over-quarter production growth.
Right.
And to maintain that volume, they end up processing significantly lower-grade ore. But that requires moving exponentially more tonnage.
More dirt.
Exactly. You're just moving dirt. You are burning more diesel, you are increasing wear and tear on your heavy fleet, and your processing costs skyrocket because you are using more reagents to extract less metal per ton.
So the volume looks great on the production report, but the unit economics completely disintegrate.
Exactly.
Here's where it gets really interesting, because rolling into 2025, the management team at First Majestic actively abandons that vanity metric.
They did.
They pivot hard to a margin over volume philosophy.
Right.
But, it is one thing to put that in a slide deck. It is another entirely to execute it.
Right, and the execution of that philosophy was the Gatos silver acquisition. Bringing the Cerro Los Gatos mine into their portfolio was the real inflection point here. They weren't just buying another asset to add ounces to their annual guidance.
They were fundamentally upgrading the geological quality of their entire production profile.
Exactly.
Because Cerro Los Gatos is a massive, high-grade polymetallic system. By integrating that asset, they immediately lowered their blended operational costs.
Right. They could actually afford to put their high-cost legacy assets on care and maintenance because they finally had this Tier 1 flagship driving the economics.
And the staggering results of that integration, coupled with the silver supercycle, gave them a record 15.4 million ounces of annual silver production.
Which is huge.
And a record $1.26 billion in revenue. That is a 124% year-over-year growth.
And the financial flow-through from that high-grade production is what triggered the massive institutional rotation into the stock. But again, revenue is just the top line. The market doesn't assign a $15 billion valuation just because a mining company managed to push their revenue above $1 billion.
So what does this all mean? The top-line growth is obviously impressive. But the real focal point of this analysis report is further down the income statement.
Yeah.
We have to look at the exact financial metric driving Wall Street's obsession with AG right now, which is their operating cash flow to sales conversion rate.
What's fascinating here is the sheer magnitude of that conversion rate. In a capital-intensive sector like mining, the operating cash flow to sales ratio is the ultimate litmus test for operational efficiency.
It really is.
It separates the companies that are just moving dirt from the companies that are actually building enduring shareholder value.
And the math First Majestic is putting up is almost structurally unbelievable for a mining outfit. On that $1.25 billion in revenue, they generated $667.2 million in operating cash flow.
It's wild.
They are converting an unheard of 53% of their top-line revenue directly into cash.
A 53% conversion rate in this sector is a complete anomaly. Usually your sustaining capital expenditures, your labor, your energy costs, and your royalty streams, they eat up 60 to 70% of your revenue before it ever gets close to becoming free cash.
Right.
Achieving greater than 50% proves that the Gatos acquisition wasn't just accretive on paper. It fundamentally altered the DNA of the company's cost structure.
The comparison the analysis report provides makes this crystal clear for you as an investor. They benchmark AG against Pan American Silver, ticker PAAS.
A very solid company.
Right. Pan American is a highly respected, well-run operator in the space. Yet, even in the super cycle, Pan American is currently converting only about 35% of its revenue to cash. First Majestic has essentially leapfrogged its biggest rival.
They are operating with tech-like margins in a heavy industry, and we have to look at the balance sheet implications of that efficiency. That 53% conversion rate has allowed AG to stockpile a war chest of nearly $1 billion in cash.
With minimal debt.
Exactly, minimal debt. In the resource sector, a pristine balance sheet like that provides total strategic immunity.
That $1 billion in liquidity is a massive moat. It means they aren't reliant on the debt markets, which is crucial given the current cost of capital.
Right.
They have the dry powder to weather any unexpected macroeconomic shocks, to aggressively return capital to shareholders via buybacks or dividends, or to act as an apex predator in the M&A space.
Oh, for sure. They can pick off distressed assets from competitors who are still struggling with high all-in sustaining costs. Wall Street is paying a premium for that exact optionality. When you have $1 billion in cash and a highly efficient flagship asset, you control your own destiny. You aren't at the mercy of the commodity cycle in the way a heavily leveraged marginal producer is.
But, and we really need to pump the brakes here, we have to look at the other side of this trade. Bring things back down to earth.
Always a good idea.
A 500% run inevitably stretches valuations, and the bear case here is substantial. The elephant in the room for any value-oriented investor looking at AG right now is the terrifyingly high trailing PE ratio, which is sitting at 93x.
Yeah, 93.
In the precious metals sector, a multiple like that usually sets off immediate alarm bells.
It does, but if we connect this to the bigger picture, we have to look past the surface level multiple and understand the mechanics of what the report calls the reversal premium.
Walk us through that.
Sure, a trailing PE of 93 is jarring, but it is heavily distorted by the company's immediate past.
Right, because the trailing 12-month look-back period still encapsulates those brutal quarters from 2024 where they were losing money and posting negative margins.
Correct. Crossing from unprofitability to sudden profitability creates a mathematical distortion. Because their trailing earnings figure is still so small, dividing their newly expanded $15 billion market cap by that tiny earnings number mathematically produces a gargantuan multiple.
So it's temporarily inflated.
Exactly. As they string together a few more quarters operating at this 53% cash conversion rate, their forward earnings will accelerate rapidly, and that 93x multiple will compress significantly.
Okay, so the PE ratio is arguably a backward-looking mirage. But the structural risks the analysis report outlines are very real. From a charting perspective, First Majestic is heavily overextended. At $32 a share, the stock is trading 118% above its 200-day moving average.
That kind of technical extension requires absolute perfection going forward. The 200-day moving average represents the longer-term structural baseline for the equity. Being extended by more than 100% means the momentum has vastly outpaced the historical trend.
Right.
The market is currently pricing in a scenario where silver remains firmly anchored near $90, the Cerro Las Gatos mine experiences zero operational downtime, and the broader macro environment remains highly accommodative.
And as we both know, in mining, operational perfection is a total myth. You are dealing with geology, geopolitics, and heavy machinery. If spot silver cools off even slightly and pulls back into the mid-70s, or if they hit an unexpected shear zone at the mine that alters their grade profile, AG has a long way to fall.
A very long way.
The analysis report identifies the nearest long-term structural support level way down around $21 a share.
That is the double-edged sword of high beta equities. The operational leverage that drove this 500% surge works with equal ferocity in reverse. If spot silver corrects by just 10%, AG's margins will compress rapidly, and the stock could easily shed 25 to 30% of its value in a matter of weeks. The margin of safety at $32 is practically non-existent.
It is the ultimate high-wire act. The stock is currently priced for absolute perfection. So to summarize the core thesis we've explored today, First Majestic Silver earned its historic 500% run through a rare combination of perfect macroeconomic timing, thanks to the silver supercycle.
And flawless microeconomic execution.
Yeah.
Exactly. Flawless execution. They caught the wave exactly as they abandoned a flawed, volume-heavy strategy. By integrating the high-grade Gatos asset, they fundamentally restructured their unit economics, resulting in that industry-leading 53% cash conversion rate. But at current valuations, the market is demanding perfection in a sector where flaws are just part of the job.
This raises an important question, and it's a thought experiment I highly recommend you apply to your own information or investments. We just dissected how a single strategic pivot from volume to margin completely transformed a struggling company into a cash-printing juggernaut.
Right.
So how many other seemingly left-for-dead companies in the broader market are currently sitting just one acquisition away from a massive structural reversal? Furthermore, when looking at your own capital allocations or business operations, are you chasing pure volume or are you focusing on the margins that actually matter?
It is a critical distinction, and it separates viable long-term strategy from superficial growth. Thank you for joining us on this deep dive. As always, keep questioning the numbers behind the headlines. We will see you next time.
Don't forget to like, share, and subscribe for more.